Okay, so as a part of our year-end procedures, what we do is we review the records that we have, and we try to address every balance and make sure that it is correct. And I just wanted to mention that account reconciliation is mainly used for assets and liabilities accounts. So what are those for the non-accountants in this webinar? So assets are simply what we own. So it's our bank account, cash in the bank, maybe some investments that we have. There could be amounts receivable, so amounts owed to us from other people and organizations, land and buildings and equipment, any kind of capital assets. And then there can be loans to others, to other organizations or maybe individuals. So those are our assets. Now, liabilities is an accounting word for debt, really. And so they would include anything we owe. So a bank line of credit, amounts payable to vendors, bank loans, and also loans from other organizations or people. Okay, so we're going to refer to them as assets and liabilities just because you guys know what I mean now, right? So to address those assets and liabilities, to make sure our balances are correct for the year end, there are two main procedures. So one is when we agree our balance to an external document, an external statement. So an example would be a bank loan, right? So if we're showing a mortgage balance in our records of $1 million, then a bank statement for that mortgage hopefully says the same, that it's $1 million right at our year end, let's say March 31st. Okay, so now in the process of agreeing the balance, we may notice that it doesn't quite agree. And this is all good because this is what the process is for. So say my mortgage is $1 million in my records. But when I look on my bank statements, it says, well, no, it's actually 950,000. So this is a good process because it gives me an opportunity to adjust my records to agree to that external source and to make sure that my mortgage balance is correct. Okay, so agreeing a balance is one of our processes that we do at year end. Another process that we do just in general to ensure that our balances are correct and all our records are correct is called account reconciliation. So you would have heard, no matter what position you're in, about a bank reconciliation, right? Which is a basic procedure we do normally at least on a monthly basis. And that procedure is making sure that our records are correct, all of them, not just the balances, but actually the individual transactions. So what's the difference between just agreeing a balance like we did for a bank loan and an account reconciliation? Well, when we agree the balance, we just look at what the ending balance is at year end, and then we agree that. When we do an account reconciliation, we actually go through every transaction in that account and we match it to a statement we receive from an external source. So for instance, in a bank reconciliation, what we're going to do is we're going to look through our what's called general ledger, which is a list of all our transactions in the bank account, and we're going to match every transaction to the bank statement. So if I had check number 1,000 for $900 in my records, I would want to match it to the same check cleared in the bank. So I would put a tick mark in my records and a tick mark on the bank statement. So why do we do it? What's the idea? So we do it because bank is considered the heart of our operations, of our organization or business. And this is because every transaction that we have in our organization goes through the bank in this way or another. Okay, and when we reconcile, when we match transactions in our records to the bank statement, we're making sure that our records are correct, because now they match with the bank statements that have all our payments and all our deposits. Okay? So now we talked about the two methods. We said there is agree in the final balance, and then there is reconciliation, which is matching every single transaction in that account. When do we use agree in the balance and when do we use reconciliation? Well, you could probably sense here that agree in the balance is kind of simpler, right? Because we're not ticking off every transaction in that account. Well, sometimes we may have timing differences between our records and that external statement that we're trying to agree to. So the best example is our bank statement. So sometimes we issue checks and we send them out, say, in the mail. So the moment we issued that check, in our records, we show a payment. So if we look in our bank account, we will see there is check that's already taken out of the bank account in our records. However, in our bank statement, the check isn't going to show up until it actually clears, which may take a while because we put the check in the mail, then somebody has to receive it and they have to deposit it in their bank, right? So sometimes there is a lag up to a month with that. And so in that kind of situation, it's not quite possible to just agree the balances, our ending balance and the statement balance, because there will be timing differences, and therefore we have to use a reconciliation for those accounts. Like I said before, reconciliation also has another purpose, where when we match every transaction to an external statement, we're actually making sure that our records are correct, because then we know that we've got all the payments in our records, and then we know if certain payments or receipts are shown in our records, but they haven't gone through the bank, then we need to investigate. Maybe we don't need them anymore. We don't need to have them in our records, okay? Okay, so let's talk about account reconciliation some more here. So we said it's an important procedure to ensure records are correct. Normally, we would use it for all our bank accounts, credit card accounts, and also intercompany or due to from accounts. So what are those accounts? So for many of us in our organizations, we have different programs, sometimes different departments. If we are at a First Nation, then we have many different departments, right? We have education, health, band office, and so on and so forth. And then individual programs within those departments. And what happens is sometimes we lend money from one department to another. So say, if the band is short of money this month for payroll, it may borrow from education or health, right? So there would be an account that's showing those transactions, band borrowing from health or education, and then repaying it back. There could be things like maybe the health office is paying rent to the band office for one of the buildings that they have. Maybe there is management fees that the band is charging different businesses that it's running from own source revenue. But because we have two different departments and we have transactions between those two departments, to make sure that records for both departments are correct, what we have to do is reconcile those two accounts. Now remember, reconcile just means we print out account for the band that's due to from, say, our health office, and then we print out the due to from the band at the health office. And then we compare every transaction in the two accounts. And this way we're making sure that records are complete and accurate for both of the departments, if that makes sense. Okay, so the technique is quite simple. I know it sounds very technical, but really what it is matching transaction by transaction. Now, in the case of a bank reconciliation or a credit card reconciliation, your software has a function. normally that allows you to do that. And so you would have a module in your software where you can go in and perform that bank reconciliation or credit card reconciliation. So you would basically go and compare every transaction to your bank, and then you tick off the ones that went through the bank and cleared. So when we do that, sometimes we can find missing transactions. So transactions may be on the bank statement, but they're not in our system. A good example is bank charges. We don't know what the bank is going to charge us until bank statement comes out most of the time, right? And so when we find those transactions in the bank statements that aren't in our records, then we would record them just to make sure that our records are complete. After we have done that, we may have some unmatched transactions. So we may have transactions that appear in our records, but don't appear on the bank statement. And so this is where we're going to pay good attention to those transactions and make sure that we still need them. So for example, if we issued checks and we know we may have delayed sending them out just for cash flow management purposes, then we know that those checks still have to clear in the future. Maybe we just sent them out, or maybe somebody's got it and they haven't cashed it, but we know they're going to clear. So we will keep those transactions in our system because we know we need them. They're legitimate payments. Sometimes what happens, however, is we have some older transactions that we really don't need. And that can happen for many reasons. For example, sometimes we had to correct the check and we forgot to delete an old check. We just created a new one, right? Different errors can happen, and then we will have some older transactions in the system. And so after matching to the bank, if we have those transactions that are older and we know that we don't need them anymore, then we can go ahead and reverse them or delete them. Okay. So now I just want to mention those older transactions is normally quite a hassle for the auditors, right? Because if they get our bank reconciliation and they have a bunch of uncleared checks or deposits in there, now they have to reverse them. So they charge us extra, then they send us an adjustment for that, and then we still have to do the work, right? Except we paid extra for it, and sometimes auditors' adjustment isn't very clear because they could do it just in one amount as opposed to reversing every single check, which really is the way to do it. So this long explanation that I'm giving you here is just to say you're always better off to do it yourself, okay? All transactions, we know we don't need them, they have to clear. A word of caution here, if your all transactions are from before this fiscal year, just be very careful with how you clear it, because if you just delete those transactions, then you would affect the numbers for the previous fiscal year. And that year has already been audited, so those numbers can't really change. Okay, so for reversing transactions from before this fiscal year, that is a little more technical. I would suggest that you may ask your auditor if you're not comfortable with doing that, but just be very careful with that. Okay. Okay, so we're going to look at bank reconciliation examples. Okay, so here's a bank reconciliation for ILDI for a while ago, and this one comes from QuickBooks Online. So every software is going to look a little different. Your software may look completely different, but they will accomplish exactly the same thing. So it would start normally with a summary that would show us summary of the bank statement. So in here you can see there was a beginning balance for the bank statement, some service charges, checks and payments cleared, deposits and credits cleared, and then ending balance for the bank statement. So this is a summary of our bank statement. Now, the idea in a bank reconciliation is that we can reconcile the balance on our bank statement to the balance in our books, okay? And so this is what we're doing here. We're saying, okay, there is $594,000 in the bank. How much is in our records? Well, here it says register balance is $571,000. So you see there is a there's a difference between the two, and normally it's just the timing difference. And the timing difference is shown here in the uncleared transactions, this $23,000 here. So basically, we wrote some checks, some payments here that haven't cleared in the bank yet. But in our view, they're still going to clear, so we're keeping them in our records. Okay, so now let's look further here. So after summary on the bank reconciliation, normally we'll have details. Okay, and in the details here, you'll see, so there is cleared checks and payments. So we have them right here. Then we have cleared deposits and other credits. And this is all good. The cleared transactions means they match to the bank statement. So we never have a problem with the cleared transactions. Okay, and then we arrive here to uncleared checks and payments. So remember that $23,000 at the top here. Sorry, I'm just making sure I got my technology going right. Okay. So if you remember, we had $23,000 of uncleared transactions here, right? Which explain the difference between bank balance and our book balance. Here it's called register balance. So the details down here in uncleared checks and payments, they tell us what's included in the $23,000. Okay, so now let's look through those uncleared checks and payments just to illustrate what I meant by all transactions. So this is a March 2019 year end. So in January, anything from March of 2019 is probably legitimate. I mean, I could still take a look at it and say, oh, no, you know, maybe I know this check already cleared. I don't know why I still have it here. Okay. But normally last month happens to be legitimate. Now, anything before that last month, so I know there is a few checks here dated in February. So this is where I would question myself, well, did they clear? Do I need them anymore? And if I don't need them anymore, I would reverse or delete them. Okay, same thing with January, especially smaller amounts. What are the chances that these are still outstanding and going to clear? And maybe they still may, but this is where we want to look at this and decide, do we need those transactions or do we not need them? And if we don't need them, just clear them. We don't want to leave it for the auditors because, again, more time, more costly audit, and you know, and then for us, we're going to have to make that adjustment anyway by recording audit adjustment. And then you'll see here, we have some transactions back from 2018. Now they're still in this fiscal year because this fiscal year is March 31st, 2019. But I think it's pretty safe to say that the transactions from 2018 are no longer needed in this bank reconciliation. So then if we do our bank reconciliation right, then before we process it, we would delete all those unneeded transactions. And sometimes it's pretty clear. Sometimes you remember, well, I remember, yeah, I had to correct that check, so I must have forgotten to delete the first one or reverse it. But sometimes we don't remember, and if it's a larger amount, we may want to investigate what happened, okay? The easiest way for me to investigate is I kind of click, here we can't do this because it's a printout, but in a software you can, I kind of click on the amount, I go in, I check all the details, because there's more details once you get into the actual transaction, and then I go to the bank statement and see if a similar amount cleared. So if a similar amount cleared, that means I probably wrote another check in this case and then forgot to reverse or delete the previous one, and then I know it's not needed, and then I would delete it. Sometimes if it hasn't cleared and then it's very old, then I would still consider reversing it. And this is because under the law, 6 months is the age of a check after which it becomes stale dated. And I just want to say, in my experience, you would think a bank wouldn't clear a stale dated check after 6 months. Well, they actually do, especially if it's a smaller amount and it goes through their automated system. And when you reach out to them, they say, well, 6 months is just the recommended thing under the law. So I still use the stale dated age as 6 months, and then I just assess, well, what are the chances that this person that may no longer be around for our organization is going to clear that check if they haven't in the last 6 months. But again, it's case by case. Okay, and so just in here, how do those uncleared transactions add up to the summary? So we see there is $24,000 in the payment section, but then there is also $1,600 in uncleared deposits and other credits. So speaking of uncleared deposit, that one is normally cleaner than your checks because there's only so many deposits that we do. And if we have outstanding deposits from earlier than our month end, it's very likely we don't need them anymore. Because the only reason a deposit can be outstanding is that we haven't taken it to the bank yet, right? And when can that happen? That can happen only very close to the month end. So say if I have an outstanding deposit from March 29th, then that makes sense because in my system, when I receive those payments from say funders or customers, I recorded them as deposits on those dates when I received them. But the bank isn't going to show it as a deposit until I actually go there and take the deposit there. So maybe in my system it's recorded as of March 29th, but in the bank it won't show up until April 1st when I actually took the deposit there. Okay. Okay. Oh, I can see we're running a bit out of time here, so I'm going to go back to the presentation. You can tell I'm all excited about accounting, right? It speaks well or maybe not so well of the rest of my life. Okay. Let's see here. Okay, so some tips for bank reconciliation. So best process is to reconcile on at least a monthly basis, because the issue is that the more time passes, the less we remember, right? So we have to review some transactions from earlier than last 3 months. I don't know about you, but I may not remember at all what happened. So it will take me longer to investigate those, okay? Now, some software has a direct download function for your bank transactions, so you could link a bank account to your software. Honestly, I resisted that for a long time, just being an accountant, I'm a little bit conservative, but once I tried it, it's awesome. It just makes your bank rec so much easier because you don't have to look at the statement too much anymore. You can automatically match in your software. So definitely worth investigating if you have that option. Now, if you can't find a discrepancy, because sometimes we've been looking at the bank rec forever and there's still a discrepancy and we can't find it, right? I find it's very helpful to just step away and maybe come back the next day because our brain just gets a little too caught up in those details and we can't see the forest for the trees or the trees for the forest, one of those. Okay, so just take a break, come back, and you can, normally you'll be surprised how quickly you find it after you've taken a break. Use deposits and withdrawals totals when looking for a discrepancy. So what happens is our bank reconciliation would normally show us total for deposits and total for withdrawals. right in the software. And so does the bank statement. So sometimes if we're looking for discrepancy, it's useful to find out which side the discrepancy is on. Is it on the deposit side or the withdrawal side? So you can compare the deposits in our system to deposits on the bank statement. And if the two agree, then you know deposits are good. You know you just have to look through withdrawals now. Okay. Outstanding checks are stale dated if older than 6 months. We said that. Again, the bank may or may not honor it. Okay, what happens when we don't reconcile accounts on a regular basis? Well, our records are likely inaccurate because we haven't compared our transactions to external source. And the ones of you that have experience with bank reconciliations, you'll know that most of the time we do find some adjustments when we do bank reconciliation, or for that reason, a credit card reconciliation or intercompany account reconciliation. So if we're behind with bank recs, our audit preparation will take longer because now we have to investigate what happened maybe half a year ago, right? And we won't always remember. Fraud and error aren't caught on time. So there actually here at ILDI, we had a few instances where an error or fraud wasn't caught on time. For instance, there was a fraudulent transaction on a credit card that didn't get caught until probably 4 months later. And this was beyond the time that credit card allows for reversing a transaction. So we had to just eat that fraud, and it was a few $1,000s there. Okay, so another example is, I know on My First Nations, we always have situations where people would double deposit the checks. So they would cash them at the store, and then they would use like a phone app to take a picture and deposit again. So I'm gonna assume that most of the time it's it's an error, lack of thinking, but nevertheless, you can't catch those if you don't reconcile a bank on a regular basis. And banks are good sometimes for reversing the second deposit, sometimes they're not. Like I've had many instances where they didn't reverse it, they didn't catch it, and by the time we went back to them, they argued because it was too late. It was a few months later. Okay, and then if you're significantly behind with bank recs or credit card recs, any kind of reconciliations, it's okay to use help, right? We've all been there. So first thing you do is you forgive yourself if you're behind. And then second thing is just think about what could help you. Many times just hiring a bookkeeping contractor, just on maybe a part-time basis or for a project, is helpful to get caught up with those reconciliations. If you don't know a bookkeeping contractor that can help you, your auditor may be able to refer you. So the last thing you want to do is leave those bank recs to your auditor, because unfortunately, auditors charge rates that are way higher than bookkeepers. So an audit firm will never do any work for less than at least $100 an hour. And you know that we can hire a bookkeeper for less than that, right? The contractor. And so if you leave it to your auditor, your audit cost is going to be way higher than you expect. Okay, so another thing we want to do is to look into funds and reconciliation. So really what it refers to is when we receive funding from Indigenous Services Canada, for instance, the revenue we have in our system, all the funding amounts received should agree to what their report in their system shows. Now, why is this important? Because for ISC, they may not have knowledge and control of our expenses, but what they know really well is how much funding they sent our way, okay? And so if our funding amounts don't agree to theirs, there is a perception right away that we don't know what we're doing, right? So many times in your quarterly reports, and for sure, as long as your revenue agrees to ISC revenue, they're going to be happy. I can see there is a chat comment here. For credit card transactions, request the limit with the bank, any purchases over 2,000 must call administrator for approval. That is an excellent point, Lori. Thank you. So controls for transactions in the bank and credit cards are really important. That's a good one for sure. And unfortunately, I have to be mindful of time, otherwise we could have more discussions here. Maybe in the future we'll have a session about controls, but definitely review them. How do we make sure there is no fraud and error? We spoke about it above, how a bank reconciliation is important for catching those things that are inappropriate. Like my most recent example, in one of my First Nations, a payroll clerk was actually, she was able to make small EFTs. So she was making unauthorized EFTs to herself and her family members, and that didn't get caught until 3 months later because we were behind with bank reconciliations. Okay. Okay, so ISC and CMHC normally send a funding confirmation report as a part of your audit package. So the audit package goes to the auditor, but you also get a copy. Okay, and so before the auditors come in, as a part of your year-end procedures, it's really important to reconcile or agree the revenue we have in the system, the funding for every program, to those funding confirmation reports. If we don't have a funding confirmation report, so sometimes we have a contribution agreement, say from Canadian Heritage or maybe our municipal government, then we have to go and look at the contribution agreement. It normally has a budget section that tells us exactly how funding will flow. So it would have payments and it would have a total. And what we want to do is agree transactions in our system to that budget. Okay, so I know we're running out of time here, but I just think it's important. So let's look quickly at the funding confirmation report example from ISC. How do I escape from here? Okay, no. Sorry, a little bit of a technology hiccup here for a second. Okay, here we go. Okay, so this is an actual funding confirmation report for First Nation for the 2020 fiscal year end. I did try removing the name everywhere just for confidentiality reasons. But there is an actual funding confirmation report. So you'll see on the first page, we don't really have any amounts. So let's keep scrolling down. Here we get down to education, right? And some summer work experience and whatnot. So you'll see in here, we have an amount that for every program. So they have funding at year end, and then total expenditure at year end, and then payable at year end. So basically what we want to pay attention to is how much is the total funding for the program. And normally you'll see the 3 columns here, the funding at year end, total expenditure, and expenditures at year end. They're all the same most of the time. So we would agree that amount of revenue to what we have in our system for education innovation in this case. Now, sometimes there is a payable at year end. Maybe they halted some funding, maybe for whatever reasons it didn't get released. So we're going to make sure that that payable at year end, which is payable from ISC side, it's actually a receivable on our side. So we're going to make sure we record that revenue as well in our year end, because ISC owes that money to us. It's just going to come later, either after they release the halts, or maybe it was already deposited in April in this case. Okay, so that's one thing to notice. So you would go through this program by program and just make sure that your funding amount in the program agrees to ISC report. And then another thing to notice here is at the bottom of the report, there is a summary of carryover surpluses for different programs. Why is this important? Well, it's because they either want it repaid, or if it's a fixed contribution program, then we can only carry over those surpluses until surplus exceeds the funding, the yearly funding for the program. So if my yearly funding for the program is $1 million, my carryover surplus cannot exceed that $1 million, because the moment it does, if my carryover surplus becomes $1,050,000, so the moment it exceeds the annual funding, ISC is going to want that $50,000 back, the amount over the annual funding in the carryover surplus. So this is a good section to kind of refer to. If we're in a set contribution program, meaning programs that aren't, they don't allow to carry over surpluses, they're actually going to want a repayment. Like in this case, social assistance, underspending from previous years, they're going to want a repayment. Okay, so there's just a quick glance at that, and we're almost done here. Thank you for your patience. Okay, so let's go back to our presentation. Oh. Okay, so the last thing I want to say is I've included audit preparation checklist that we use here at ILDI for training purposes, but also for the purposes of preparing for ILDI audit. And just because we don't have time to go through it, but I thought, well, if you're working on the year end, you may find it helpful to refer to that checklist, because it tells you how to address every balance in your records. That's important for the auditors. So that will be included with the information for this webinar. I'll email it to Chantel. And that's it for this presentation. Thank you for your patience again. Any questions that you may have, please email them to Chantel, and she will make sure everybody gets answers. I am good to answer some questions now, if that's okay, Chantel.
That's fine. Can you hear me?
Yeah. Okay, great. Okay, so if you